By the end of this video, you should have a clear understanding of one of the most fundamental concepts in any trading business: buying low and selling high. Participants will be able to calculate profit and loss for any foreign exchange or contract for difference transaction, regardless of the trading platform used or the quotation system followed. You will also learn how the retail Forex market has standardized trading contracts across different brokerages, ensuring consistency in the trading process. Finally, you will understand the concept of leverage and how it affects the potential gains and losses for retail traders, helping you to manage your risk more effectively. One of the most basic principles in any business is to sell your product at a higher price than you purchased it, in order to generate a profit. Whether you're selling apples at a farmer's market, electronic gadgets in a mall, or currencies through an online trading platform, the formula for determining whether you've made a profit is simple. Profit is equal to selling at a higher price minus buying at a lower price. To achieve a profit, you aim to sell at a price higher than your original purchase price. This concept applies universally across different types of businesses, including Forex trading. The goal remains the same: buy low, sell high. One of the key differences between trading Forex and other financial instruments, such as bonds, stocks, or commodities, lies in how profits and losses are accounted for. Most financial instruments are priced in the currency to which they are issued. For example, stocks and bonds are typically priced in the domestic currency of the issuing country, and commodities are often priced in US dollars globally. However, in Forex trading, we are pricing one currency against another, creating an exchange rate between the two. This means that the concept of profit or loss isn't tied to a single currency but is relative to the two currencies being traded. Additionally, Forex traders may use a third currency for reporting purposes, known as the functional currency, which may differ from the two currencies in the trade. For example, a trader in Japan could trade euro to US dollar, but the profit or loss might be reported in Japanese yen. This multi-currency dimension adds a unique layer of complexity to profit calculation in Forex, as exchange rate fluctuations between the trading pair and the functional currency can impact the final profit or loss. Most retail traders, especially those based in the US, typically trade Forex using US dollars as their reporting or functional currency. When trading directly quoted currency pairs like Euro USD or GBP USD, they use a simple formula to calculate profit or loss. Profit or loss is equal to the selling price minus the buying price multiplied by the amount. Alternatively, you can break it down as profit or loss is equal to selling price times the amount minus buying price times the amount. For example, if a trader buys 100,000 NZD USD at 0.6100 and later sells it at 0.6170, the calculation would proceed as follows. The trader buys 100,000 New Zealand dollars using 61,000 US dollars, that is, 100,000 times 0.6100. When the price rises to 0.6170, the trader sells the 100,000 New Zealand dollars he has and receives 61,700 US dollars, that is, 100,000 times 0.6170. The profit is calculated by subtracting the amount initially spent from the final amount received. By simplifying, 61,700 minus 61,000 is equal to 700. In this example, the trader makes a $700 profit from the transaction. When dealing with indirectly quoted currencies, it's important to remember that the formula profit or loss is equal to selling price minus buying price is expressed in terms of the term's currency, which is the currency on the right-hand side of a currency pair. For example, if we buy USD JPY at 133 and later sell it at 135, we have profited by 2 yen. However, this profit is in yen, which is the term's currency, and must be converted into our functional currency, that is the US dollars. To convert the profit into the functional currency, you would divide the result by the exit price, or the price at which you closed the trade. In this case, you would divide the 2 yen by the sell price of 135 to calculate your profit in US dollars. For instance, if we bought 75,000 US dollars, the calculation would be profit or loss is equal to selling price minus buying price times amount. This implies that 135 minus 133 times 75,000 is equal to 2 times 75,000. Thus, equal to 150,000 JPY. Next, you need to convert the 150,000 yen profit into the functional currency, which is the USD. To do this, divide the profit by the exchange rate at the time of the exit, or the sell price, which is 135. So, the profit in USD is equal to profit in yen divided by the closing price. Therefore, 150,000 divided by 135.00 is equal to 1,111.11. So, the profit in US dollars is $1,111.11. We now understand that when computing profit and loss for currency transactions, especially for indirectly quoted pairs, we must be mindful of the need to convert profits or losses back into our reporting currency or functional currency. But what happens when we trade third currencies? How does the computation work in such cases? Let's take the example of trading GBP CHF. Suppose we exchange 250,000 British pounds worth for Swiss francs at an ask price of GBP CHF at 1.1250. And later close the trade at a bid price of 1.1100. The profit or loss calculation would be as follows. Profit or loss is equal to selling price minus buying price times contract size. This implies to 1.1100 minus 1.1250 times 250,000. By simplifying, it is equal to 1.1100 times 250,000 minus 1.1250 times 250,000. Thus, 277,500 minus 281,250, which is equal to negative 3,750. So, in this example, we have a loss of 3,750 Swiss francs. How then do we account for the profits in US dollars? To convert the profit or loss from Swiss francs to US dollars, we use the following formula. P&L in USD is equal to P&L in CHF divided by USD CHF rate at the time of closing. For example, if the USD CHF exchange rate is 0.8650 at the time of closing, meaning it takes 0.8650 Swiss francs to buy 1 US dollar, the calculation would be P&L in USD is equal to negative 3,750 divided by 0.8650, which is equal to negative 4,335.26. So, the loss in US dollars would be $4,335.26. In retail Forex trading, standardized contract sizes are used, meaning trades are typically conducted in 100,000 units of the commodity currency per contract or lot. The formulas for calculating profit and loss differ slightly depending on whether you're dealing with directly quoted, indirectly quoted, or third currency pairs. Indirectly quoted, for example, Euro USD and GBP USD. P&L is equal to selling price minus buying price times contract size times lots. In indirectly quoted, for example USD JPY and USD CHF, P&L is equal to selling price minus buying price times contract size times lots divided by the closing price. In thirds or cross rates, P&L is equal to selling price minus buying price times contract size times lots divided by the exchange rate of functional currency at the time of close. Now that we know how to compute profits and losses, let's discuss a key feature of Forex trading: leverage. Leverage is a powerful tool that enables retail traders to compete on a level playing field with large money managers in the Forex and OTC markets. In trading, leverage refers to the practice of borrowing capital to increase the potential return on an investment. By using leverage, traders can control much larger positions with only a small amount of their own capital, thereby magnifying both potential gains and losses. Leverage is typically expressed as a ratio, representing the notional value of the investment relative to the minimum amount of funds, called margin, which is required to open the trade. Common leverage ratios include 1 to 10, 1 to 100, 1 to 200, and even 1 to 1000. The leverage ratio determines the amount of margin required to hold a position. For example, with a 1:10 leverage ratio, the trader must have 10% of the total trade value as margin. So, to trade $1 million, the trader would need $100,000 in their account. With a 1 to 100 leverage ratio, only 1% of the trade value is required as margin. For a $1 million trade, the required margin would be $10,000. With 1 to 500 leverage, the trader needs just 0.2% of the trade value. In this case, a $1 million trade would require $2,000 in margin. Leverage allows traders to control large positions with minimal capital, but it also amplifies the risk. While the potential for greater profits is increased, the risk of larger losses also rises, making it crucial for traders to use leverage responsibly and implement risk management strategies. Thank you for watching the final video in the Introduction to Financial Markets series, Business Basics. By now, you should have a solid understanding of how the foreign exchange market operates and how traders can profit regardless of economic conditions. Before proceeding to the next series on market analysis, please take the accompanying quiz to assess your understanding of the concepts covered in this video.